Let's bring in Tony Dwyer of Canaccord Genuity. Tony, obviously you're listening to this. Dan is very emphatic about, sort of the way that we need to be looking at this. The only real historical model we might have in America is 1957, where we had a flu pandemic, had 116,000 souls unfortunately lost, which as a percentage of the population back then was very high, higher than some of the models we have right now. You've been listening to us. What do you think? Do you think today meant anything or just a bear market rally inside of a down market?
Well, first, Brian, Dan being emphatic, really? So does it mean anything? 100% it means something because less people are, it looks like, the curve is flattening sooner or peaking sooner than people expect. And that's a great thing. But from our view has not changed, Brian, since we talked to you last and the time before that. Once you started that 12% decline in April, remember, it was the fastest correction in the history of the S&P from a new high to a greater than 10% correction. I think it happened in 6 days. As soon as you did that, you kicked off a human nature event. And there's three phases of a crash environment. There's the panic phase. We clearly got that with a 34% drop when there was a 0.86 correlation of S&P stocks to the index itself. A record, 3 standard deviation event. We got the panic phase. Then you go into the multi-week relief rally phase. And again, we've been talking about this since that 12% drop in February. A multi-week relief rally phase, median is 17%. When the 14-week RSI gets to where it got in late March. In other words, this is a typical multi-week relief rally. Then, unfortunately, when you're in a human nature event, you test the lows. It's a very frustrating period because the panic phase is, oh, my God, what was that? Everybody's looking around like, what is it going to mean? Fear takes over. Panic sets in. Then you kind of say, oh, my God, thank God that's over. And then people look at people like me saying it could test the low and saying, no, it's going to be different this time because of how dramatically it declined. And then you get this relief rally followed by a test of the low. So we have a bunch of indicators that suggest that that's going to happen again this time.
Yeah, in the next month or so, do we have a time frame on this, Tony? Listen, I get it. I get Dan.
Brian,
I get everybody's point.
I'm a data guy.
Don't rush this. It's got to work through. Yeah, it's got to work through.
If I traded by my emotions, that'd be a disaster.
People.
Right, I've changed on Friday midday. It looked like the market was going to crash. Today it looks like it's going to spike forever. So let's go by the data. When the 14-week RSI, which is the relative strength index for the S&P 500, it's a common oscillator looking at overbought and oversold, reached 22 on March in the week closing March 20th. Anytime it's done that in the past, since it's been a 500 stock index, you have had a relief rally just like with, again, median 17%. The test of the low comes a median 28 days later. And it gets half the time it broke the low marginally, and the other, with 2008 being the worst exception, and the other 3 times it came within 4% of the low. So our call is very simple. The market crashed. If you're going to look out 10 years from now, it doesn't matter if you wait for the low. Ultimately, the stimulus, monetary and fiscal stimulus, is going to be really stimulative, and it'll be a generational low. However, human nature is driving the bus here, and human nature really reinforces after a crash, after an oversold condition, that you test that low. I wish it weren't true, but that's the data.
All right, well, we're looking at the data, and that's why we have you on. Tony Dwyer of Canaccord Genuity. Tony, thank you very much.